Something extraordinary is happening right now. Banks are reportedly recruiting political coalitions. Crypto legislation is approaching a critical deadline. Ripple is expanding internationally. Artificial intelligence is merging with tokenized assets. And while all of that is happening, the United States may be sleepwalking into a threat that could eventually break the cryptography protecting trillions of dollars. Sounds unrelated, right? It's not, because every one of these stories connects to a single question. Who controls the future financial system? And the answer may be decided sooner than most people realize. Before we dive in, I need to get something important out of the way. This video is for educational and informational purposes only. Nothing here constitutes financial, legal, or investment advice. Always do your own research and consult with qualified professionals before making any financial decisions. The Wealth Continuum is not a financial advisor. All right, now that's settled. What do you think? Is this the most important financial debate happening right now, or are there bigger stories that deserve attention? Drop your thoughts in the comments because I'm genuinely curious where your head is at. And if you're new here, welcome to the Wealth Continuum. If you want to understand where money is heading and who decides its future, you're in exactly the right place. Hit that subscribe button and stick around because what I'm about to show you might change how you see the entire financial landscape. Stay until the end because one development involving banks, politicians, and even religious organizations could completely change the timeline for crypto regulation in America. Let's get into it. The countdown has officially started and the clock is ticking louder than most people realize. Senator Cynthia Lummis recently suggested that lawmakers are pushing toward a major crypto regulatory milestone right around the July 4th period of 2026. Now that alone would be significant under any circumstances. But what happened in the days following that announcement is what really caught everyone's attention and sent shockwaves through both Washington and Wall Street. Because the closer crypto legislation gets to becoming actual law, the harder the opposition appears to be pushing back with an intensity that frankly surprised even seasoned political observers who have been tracking financial regulation for decades. According to multiple reports and political insiders who have been monitoring this behind the scenes, traditional banking interests are not sitting quietly on the sidelines waiting for the dust to settle. They are mobilizing in ways we have not seen in years. They are lobbying aggressively across both chambers of Congress, and they are trying to build broad coalitions capable of slowing, reshaping, or even derailing crypto legislation before it reaches the finish line. Now, here is where things get genuinely strange, and I want you to pay close attention to this next part because it is not something you will hear discussed on mainstream financial news. Some reports suggest that organizations tied to religious and community groups have somehow become involved in the regulatory debate, which immediately raises an obvious question that deserves a real and honest answer. Why? What on earth does cryptocurrency regulation have to do with churches and community organizations? At first glance, the stated reasoning seems perfectly reasonable and even noble on its face. Consumer protection for vulnerable populations, financial safety for everyday Americans, concerns about human trafficking and illicit financial flows that exploit digital currencies. These are legitimate issues that deserve serious attention from lawmakers, and nobody in the crypto community is arguing otherwise. But critics are not buying the official narrative, and the skepticism is growing louder by the day as more details emerge about who is funding these efforts. Many in the crypto community argue that this sudden involvement is not really about trafficking or consumer safety at all. They believe it is about something much bigger and far more consequential: control. Because if crypto regulations finally become clear and comprehensive, banks may face a level of competition they have not experienced in decades, and that possibility is making some very powerful people extremely nervous about their future market share. What are your thoughts on this? Comment below if you think the involvement of these organizations is genuine concern or a strategic play, because I genuinely want to hear your perspective, and I read every single comment. Now, if you want to understand what is really driving this opposition, you have to follow the money, and the trail leads to some very familiar names that dominate the American financial landscape. JPMorgan Chase and other major banking institutions have been pouring significant resources into political donations, grants, and lobbying efforts that directly intersect with financial technology regulation in ways that are difficult to track without specialized knowledge. We are talking about millions of dollars flowing into organizations and political action committees that have historically opposed decentralized finance and digital asset innovation. And when you look at the timing of these donations alongside the legislative calendar, the pattern becomes genuinely difficult to ignore even for the most skeptical observer. Is it a coincidence that lobbying spending from traditional finance spikes precisely when crypto clarity bills gain momentum in Congress? Or is it a deliberate strategy designed to protect entrenched interests at the expense of innovation and consumer choice? I will let you decide, but the correlation is hard to dismiss once you see the data laid out side by side. What happened next makes this even stranger. Because the lobbying efforts are not just targeting individual lawmakers anymore, but are now targeting entire voting blocks and community organizations that can apply pressure from the grassroots level upward in ways that are much harder for the public to detect. Hit like if you think transparency in political lobbying should be mandatory for all financial institutions, because this is exactly the kind of issue that affects every single one of us, whether we hold crypto or not. Stay with me, because the next part is crucial to understanding why the next few weeks could be the most important period in crypto history and possibly in the broader evolution of the American financial system. The banking groups pushing for delays are operating under a very specific and calculated assumption that deserves closer examination. They understand that once a clear regulatory framework is established and codified into law, it becomes exponentially harder to reverse or undermine through regulatory enforcement actions. Clarity creates certainty for businesses and investors, certainty attracts institutional capital at scale, and institutional capital creates the kind of competition that traditional banks have spent decades insulating themselves against through regulatory capture and market consolidation. This may genuinely be their last real opportunity to shape the rules before the window closes permanently and the industry matures beyond their ability to control it. The coalition-building efforts we are seeing right now represent a last-ditch attempt to fragment the pro-crypto voting bloc in Congress by introducing wedge issues that divide lawmakers who might otherwise support comprehensive legislation on a bipartisan basis. And here's what they are not telling you. The internal polling data that many of these banking groups are relying on suggests that public support for crypto regulation has actually increased significantly over the past 2 years, which means the traditional narrative that crypto is a fringe issue affecting only a small group of speculators no longer holds water in any meaningful sense. The people are paying attention, the voters are organizing, and the banks know it better than anyone. How is the weather where you are watching this from, by the way? I always find it fascinating that we are all experiencing this pivotal moment in financial history from completely different corners of the world, yet the decisions being made in Washington over the next few weeks will ripple out to affect every single one of us, regardless of geography or whether we even own a single digital asset. This is where the political calculus starts to shift dramatically, and it is a shift that many establishment politicians are still underestimating, at their own considerable peril heading into the election cycle. The midterm elections are approaching, and for the first time in American political history, crypto voters represent a meaningful and organized voting bloc that can no longer be safely ignored by candidates on either side of the aisle. We are talking about tens of millions of Americans who own some form of digital asset and who have made it abundantly clear through surveys and voting behavior that they will cast their ballots based on a candidate's stance on financial innovation and digital property rights. The people that lawmakers casually ignored 4 years ago may very well decide who wins the next round of elections. And that realization is finally starting to sink in among politicians who previously considered crypto a non-issue. Politicians who previously dismissed digital assets as a passing fad or a tool for criminals are now quietly meeting with industry leaders and publicly reconsidering their positions in ways that would have been unthinkable just a few years ago. The political chessboard has fundamentally changed, and the players who refuse to adapt to this new reality are going to find themselves on the losing side of history when the votes are counted. But here's the question I want you to sit with for a moment and really think about honestly. Do you think politicians genuinely care about crypto voters and their concerns? Or are they simply chasing votes the way they chase every other demographic when election season rolls around? Share this with someone who needs to see it, because the political dimension of this story is something that most people completely overlook when they focus only on price charts and technical analysis. While all of this political theater plays out in Washington with all of its dramas and uncertainty, something remarkable is happening on the international stage that puts American hesitation into sharp and somewhat embarrassing perspective for anyone paying attention. Ripple has been aggressively pursuing regulatory clarity in markets outside the United States, and the results speak for themselves in ways that American regulators can no longer afford to ignore. Japan has moved forward with approving RLUSD, Ripple's stablecoin offering, signaling a level of regulatory confidence and institutional trust that stands in stark contrast to the ongoing gridlock and enforcement-first approach that has characterized the American regulatory environment for years. Other nations across Asia, the Middle East, and Europe are establishing clear and welcoming frameworks that attract blockchain companies and institutional investment by the billions, while the United States remains stuck in a frustrating cycle of enforcement actions, contradictory agency guidance, and legislative delays that drive innovation offshore. The contrast could not be more glaring or more consequential for American economic competitiveness. While Washington debates and delays and forms yet another committee to study the issue further, other countries are moving decisively to capture the enormous economic benefits of the digital asset revolution that American companies and developers largely pioneered. And this creates a fascinating and troubling paradox that deserves much more attention than it currently receives. The very regulatory uncertainty that American banks claim to be concerned about is actually driving innovation and capital overseas, which ultimately weakens the competitive position of the American financial system that those same banks claim to be protecting through their lobbying efforts. You need to understand this international context before I show you what is next, because the global dimension of this story is about to collide with the domestic political timeline in a way that could accelerate everything we have been discussing. Comment below if you think the United States is falling behind in the global crypto race, because the data increasingly suggests that the window of American leadership is closing faster than most analysts predicted even 6 months ago. This is where the political chess match reaches its most critical and precarious phase, and the calendar is not doing anyone any favors as competing legislative priorities pile up on an already congested Senate schedule. The Senate is facing a compressed legislative timeline with multiple high-stakes priorities fighting for extremely limited floor time in the weeks leading up to the summer recess. Housing legislation complications are creating procedural bottlenecks that threaten to push crypto bills further down the calendar and potentially out of reach entirely for this session. Senator Elizabeth Warren and her allies continue to leverage procedural tools and committee positions to slow the process at every available opportunity, while the Trump administration is applying its own form of leverage from the executive branch through statements and policy signals that create a complex three-way dynamic making reliable prediction nearly impossible for even the most experienced political analysts. The reality is that the Senate may have only a narrow window of a few weeks to act before the legislative calendar becomes consumed by other priorities, and the political dynamics shift again in unpredictable ways. Frame it however you want, but this is political chess at the highest level with enormous financial consequences, and the players involved understand that the stakes could not be higher for the future of American financial innovation. But here is what they are not telling you about the Senate timeline that could change everything. There are backroom negotiations happening right now that could either fast-track a comprehensive bill or kill it entirely before the public even knows what happened, and the outcome may hinge on a single procedural vote that most Americans will never hear about in the news. Stay with me, because I am about to shift gears entirely, and the next section of this video is where the story takes a dramatic turn that almost nobody in the crypto community is talking about yet. Stop for a second and take a breath, because if you think this story is only about regulation and political maneuvering in Washington, you are missing what happened on Wall Street just this past week, and it connects to everything we have been discussing in ways that will become painfully clear very shortly. What are you doing while watching this video right now? Are you at home relaxing, at work on a break, or commuting somewhere? I ask because the decisions being made in the markets at this very moment are going to affect your financial future, regardless of where you are sitting, and I want you to be fully present and engaged for what comes next, because it directly impacts your portfolio. The broader technology sector has been showing significant and increasingly alarming signs of weakness, and the cracks in the foundation are becoming impossible to ignore, even for the most optimistic bulls. Risk assets across the board are under mounting pressure as macroeconomic headwinds intensify, and investor sentiment shifts noticeably from exuberance to caution in ways that typically precede our larger drawdowns. The tech-heavy indices that led the market higher over the past several years are now giving back gains at an accelerating pace, and the correlation between traditional technology weakness and crypto market volatility is becoming increasingly pronounced and difficult for digital asset holders to ignore. This matters enormously for the broader crypto narrative because institutional investors who allocated to digital assets as part of a larger technology and innovation investment thesis are now reassessing their positions in an environment where risk appetite is contracting rapidly across all asset classes. The question is no longer whether crypto can survive a tech downturn in isolation, but whether the regulatory clarity we discussed earlier can provide enough fundamental support to decouple digital assets from the broader risk-off sentiment that is gripping global markets heading into the second half of 2026. This is where it gets really concerning for anyone with significant exposure to growth assets, because the market weakness we are seeing is not just a short-term correction that will reverse on its own, but potentially the beginning of a more structural repricing of risk assets that could persist for months and reshape portfolio allocations across the institutional landscape. And speaking of structural repricing and institutional exposure, we absolutely need to talk about strategy, formerly known as MicroStrategy, and the enormous test that Michael Saylor's flagship Bitcoin vehicle is currently facing in one of the most challenging market environments in its history. The stock has experienced significant weakness in recent weeks, and the premium that investors have historically been willing to pay for Strategy's Bitcoin holdings relative to the underlying net asset value is compressing in ways that have the market increasingly nervous about the sustainability of the entire model. The STRC preferred shares have also seen notable declines that raise serious questions about the capital structure that Saylor has built over the past several years through increasingly creative and leveraged financing arrangements. Growing skepticism from institutional analysts and short sellers is creating a dangerous feedback loop where declining premiums put pressure on the stock price, which in turn raises questions about the company's ability to continue its aggressive Bitcoin acquisition strategy that has been the cornerstone of its corporate identity. What happens if investors stop believing the premium story that has been the foundation of Saylor's entire approach to corporate Bitcoin accumulation? It is a question that the market is beginning to grapple with seriously for the first time, and the answer could have profound implications not just for strategy shareholders, but for the broader narrative around institutional Bitcoin adoption that has driven so much capital into the space over the past 2 years. Hit, like if you think Saylor's strategy will ultimately be vindicated by future Bitcoin price appreciation. Or comment below if you believe the premium compression is the beginning of a larger unraveling that could shake confidence in institutional crypto adoption, because this is one of the most polarizing and consequential debates in the entire crypto space right now. Now I need you to lean in and really focus for this next section, because it may be the single most important long-term risk that almost nobody in the crypto space is adequately pricing into their investment thesis, and it connects directly back to the opening moments of this video in a way that will give you chills. President Trump recently signed new quantum computing initiatives that have dramatically accelerated federal investment in quantum research and development. And while the stated goals of these initiatives are focused on national security and scientific advancement, the implications for the cryptographic foundations of digital assets are absolutely staggering and deserve far more attention than they are currently receiving. Let me explain this simply so that everyone can follow along regardless of their technical background. Quantum computers, once they reach sufficient scale and stability, will have the theoretical ability to break the cryptographic algorithms that currently secure Bitcoin, Ethereum, and virtually every other digital asset in existence, effectively rendering the security model that underpins trillions of dollars in value completely obsolete. We're not talking about a distant theoretical threat that is decades away anymore. The timeline for quantum advantage has been accelerating faster than most cryptographers predicted even 2 years ago. And the gap between when quantum computers become capable of threatening current encryption standards and when blockchain networks complete their transition to quantum-resistant algorithms is narrowing in ways that should deeply concern everyone holding digital assets of any kind. Ethereum's development community has been more vocal and proactive about quantum preparedness, with active research programs focused on post-quantum cryptographic standards and transition planning. But Bitcoin's more conservative and deliberate governance structure means that any transition to quantum-resistant signatures would require an extraordinarily high level of community consensus that could take years to achieve through the normal upgrade process. This may be the biggest long-term risk that nobody is pricing in, and the profound irony is that the same government that is struggling to pass basic crypto regulation is simultaneously funding the very technology that could eventually render that regulation entirely moot by breaking the cryptography it seeks to govern. Subscribe if you want to see more deep dives into the quantum threat to crypto and what you can do to prepare, because this is a story that is going to become exponentially more important and more urgent over the next several years, whether the market is paying attention or not. And as if the quantum threat were not enough to process and integrate into your long-term thinking, the artificial intelligence revolution is accelerating at a pace that is fundamentally reshaping the relationship between technology and finance in real time and creating demand for blockchain infrastructure that simply did not exist even 2 years ago. Companies like Bitmine have recently entered the Russell 1000 index, signaling that the intersection of artificial intelligence and blockchain infrastructure is no longer a speculative narrative confined to crypto Twitter, but a recognized and investable sector of the broader economy that mainstream institutional investors are beginning to take seriously. Tokenized stocks are gaining significant traction as artificial intelligence agents begin executing trades and managing portfolios autonomously at speeds and scales that human traders cannot match, creating demand for on-chain settlement and verification that traditional financial infrastructure simply cannot handle without massive and costly upgrades. The implications of this convergence are enormous and frankly difficult to overstate, even with the most aggressive projections. Artificial intelligence agents will need to transact with each other in real time across borders, without human intermediaries or traditional banking hours, and the only infrastructure capable of supporting that kind of machine-to-machine economy at global scale is blockchain technology operating 24 hours a day, 7 days a week. The energy and transaction demand generated by billions of AI agents interacting with tokenized assets could dwarf anything we have seen in the crypto space to date, potentially driving adoption and utility to levels that would make the current market capitalization of the entire digital asset ecosystem look like a rounding error in the grand scheme of the global economy. This is not wild speculation or hype. This is the logical and inevitable endpoint of technological trends that are already well underway and accelerating, and the institutions that understand this convergence are positioning themselves aggressively while everyone else is still arguing about whether Bitcoin is primarily a store of value or a medium of exchange. And now we arrive at the real reason banks may be panicking behind closed doors, and it is not what you might expect based on the headlines you have been reading. It is not because crypto is winning today in some simplistic scoreboard sense that can be measured by a single price chart. It is not because Bitcoin hit a particular price level, or because Ripple launched another product, or because any single headline dominated the news cycle this week. It is because every single trend we have discussed today points unmistakably in the same direction, and the convergence of these trends creates a compound effect that is far more powerful and disruptive than any individual development could ever be on its own. Clearer regulation is coming whether the banking lobby likes it or not, and the political momentum behind it is now too strong to reverse. Artificial intelligence is creating demand for blockchain infrastructure that did not exist 2 years ago, and that traditional banking systems cannot replicate. Tokenized assets are moving from proof of concept to production at major financial institutions that were dismissing the technology just a few years ago. Global adoption is accelerating even as the United States hesitates, creating competitive pressure that American regulators can no longer ignore. And political support for digital asset innovation is growing with each election cycle as the crypto voting bloc becomes too large and too organized to dismiss. Individually, each of these trends is manageable for the traditional banking system, and they can adapt to any single disruption if given enough time and resources to adjust their business models. But together, they represent a financial system that looks radically and fundamentally different from the one that banks spent decades building, protecting, and profiting from through regulatory moats and information asymmetries, which explains why the fight over regulatory clarity may be much bigger than a single bill working its way through Congress this summer. It may be a battle over who controls money itself in the next decade, and the outcome of that battle will affect every single person watching this video regardless of whether you own a single Satoshi or have never touched a digital wallet in your life. The next few weeks could determine whether crypto finally gets the comprehensive regulatory framework that the industry has been demanding for years. And if that happens, the consequences will reach far beyond Bitcoin, XRP, Ethereum, or any single token that you happen to hold in your portfolio today. Because what is really being decided right now in committee rooms and lobbying offices and Senate chambers that most of us will never see or enter is who writes the rules for the future of finance for generations to come. And that battle is only getting started, not winding down. If you found genuine value in this breakdown, I would deeply appreciate it if you subscribe to the Wealth Continuum so you never miss these deep dives. Hit that like button to help this video reach more people who need to hear this information, and share this video with someone in your life who needs to understand what is happening behind the scenes of the financial system they rely on every single day without even thinking about it. And I want to leave you with one final question that I hope you will take seriously and answer thoughtfully in the comments below. Do banks still control the future of finance? Or has that future already escaped their control in ways that they are only beginning to realize as the ground shifts beneath their feet? I read every comment that comes through, and I genuinely want to know what you think, because your perspective matters in this conversation. Until next time, stay curious, stay informed, and remember that the most important investment you can ever make is in your own understanding of the world around you and the forces that are shaping it, whether you pay attention or not. This has been the Wealth Continuum, and I will see you in the next one.